Welcome to the Deep Dive, the shortcut to being well-informed. We take the source material, the dense transcripts, the investor notes, all that market chatter, and we just extract the critical knowledge you need.
And today, we're focusing on Dell Technologies, specifically their fiscal Q3 2026 earnings call, which hit the wires after the close on Monday, November 25th.
And this is an essential one because really the story here wasn't just some small incremental update.
No, not at all. This call confirmed a really profound strategic acceleration. The whole narrative was completely dominated by just two things.
Okay, what are they?
First, unprecedented AI order growth. And second, a massive, massive increase in their full-year guidance. These two factors, they completely overshadowed any minor operational weakness.
Right, and the market reaction told the story. The stock confirmed that conviction immediately.
It did. It traded up significantly the next day on about twice the normal volume. It was a very clear signal that the market believes in this AI story.
So, our mission today is to unpack all of this. We're going to go beyond the headlines, we'll analyze that stunning guidance raise, and really dig into what management is calling, very confidently, the AI infrastructure supercycle.
Let's start with just a quick snapshot of the results for you. So for Q3, on a non-GAAP basis, earnings per share came in at $2.59.
Which is a pretty healthy number.
Very healthy. That's a 17% increase year over year, a new Q3 record, and importantly, it beat the street consensus of $2.47 by about 12 cents.
Okay, so a solid beat on profitability, but the top line, the revenue side, that was a slightly different story, right?
It was, yeah. Revenue came in at $27 billion, also an 11% year-over-year increase, also a Q3 record. But the consensus was a little higher.
How much higher?
In the 27.1 to 27.2 billion range. So, technically it was a fractional miss.
And this is really the core insight, isn't it? That miss, which was less than 1%, was basically forgotten within minutes of the call starting.
No, completely forgotten. Because the beat on the bottom line, combined with the sheer velocity of the momentum they communicated, it just shifted the entire focus away from the Q3 numbers and onto the future.
You can't really worry about a tiny revenue miss when the conversation is about this kind of growth.
Exactly. And that brings us right back to the core engine here. AI management called out exceptional AI momentum and said it really accelerated in the second half of the year.
Okay, let's get specific on that scale because the numbers are frankly huge.
They're massive. Dell reported record Q3 AI server orders of $12.3 billion.
12.3 in a single quarter.
In a single quarter. And if you zoom out for the listener, that one quarter pushes the year-to-date AI server orders to a colossal $30 billion.
Wow. And how much of that actually shipped?
They shipped 5.6 billion of AI servers in Q3. But the real story, the thing that gives you visibility into future revenue, is the backlog.
Which exited Q3 at a record $18.4 billion. That's already booked. It's just waiting on parts and assembly.
Exactly. And all this growth is happening inside their Infrastructure Solutions Group, or ISG. That's servers and storage.
Yeah.
ISG revenue hit $14.1 billion, a 24% year-over-year growth. It's the primary driver of the whole company right now.
And within ISG, it's really the servers and networking piece that just completely exploded.
Oh, absolutely. $10.1 billion. That's a 37% year-over-year increase. It's very clear where all the resources are flowing.
It is. Storage, that's a different story.
A very different story. Revenue there was $4 billion, which is actually down 1% year-over-year. Now, management was quick to point out that their own IP storage, like PowerStore, was strong.
Right.
But that growth was kind of muted by slower traditional storage sales and just the sheer dominance of the server business.
That makes sense. The tail is being wagged by the server dog right now. But let's quickly touch on the other side of the house, the Client Solutions Group, CSG, PC business.
Right. CSG revenue was $12.5 billion, so up a modest 3%. The strength here is still commercial clients. That segment grew 5% to $10.6 billion.
And consumer.
Consumer demand was soft, down 7% to $1.9 billion. But, management spent a lot of time framing the whole PC segment, not around today's softness, but tomorrow's opportunity.
The refresh cycle.
The refresh cycle. They see this massive opportunity coming, they think, in fiscal 2027 for two reasons. First, you've got an aging install base. They estimate about 500 million PCs are 4 years old or older.
And second, the slow transition to Windows 11. A lot of those old machines just can't run it.
Exactly. It forces an upgrade. So it's a deferred demand story.
Okay, let's go back to that $30 billion AI number. When you have growth moving this fast, the immediate question from the street is always about profitability. Is it sustainable?
That is the core conflict. Their COO, Jeff Clark, is pushing this narrative of what he calls AI factories, integrated systems. The idea is that Dell isn't just selling boxes.
They're selling a full stack solution.
Right. Engineering expertise. They emphasize they can get these AI racks fully operational within like 24 to 36 hours of delivery with over 99% uptime. That execution, they argue, justifies a premium.
But what are the actual margins? Because the corporate non-GAAP operating margin was 9.3%. Are these AI servers actually helping that number yet?
So this is what's so fascinating. The corporate margin improved a little, up 10 basis points. But the AI servers themselves are still generally lower margin. The goal they've talked about is getting them into the mid-single-digit operating profit range.
And are they there?
What they confirmed is that they are seeing sequential improvement. So the AI servers are becoming less dilutive to the overall margin, but they are not yet accretive. They're not yet helping the average.
That's a critical distinction for the listener. The profitability is improving, which mitigates the risk, but the rapid growth is still relying on the higher margin traditional business to hold up the corporate average.
Precisely. And adding to that pressure, management was really candid about a major headwind: component inflation.
Memory prices.
Memory prices. DRAM and NAND. They called the increase unprecedented and noted that it affects basically every single product they sell.
That sounds like a huge potential drag that could just wipe out those margin gains. How are they planning to counter that?
This is where their direct business model becomes a strategic advantage. Unlike competitors who rely on channel partners, their direct relationship with clients lets them adjust pricing and product mix much faster.
So they can pass the costs on more quickly?
More quickly, and they can push higher margin software and services to offset it. They actually said they believe their cost recovery rate will be better than the historical standard, which is about 2/3 recovery within 90 days.
That's a bold claim.
It is. And it's based on their supply chain execution and, crucially, the scarcity of these parts. If you're one of the few who can get the components, you can dictate the price.
And even with all those headwinds, this is where the conversation completely pivots, because the forward guidance just defied any lingering skepticism about costs.
This was the moment. It was a massive signal of conviction. The core AI server shipment target for the full fiscal year 26 was raised dramatically. It jumped from 20 billion to a new target of $25 billion.
Wow. That's a $5 billion guidance bump. That just papers over any short-term margin fears.
It does. And that raise implies that Q4 shipments alone will hit 9.4 billion. I mean, that's a velocity we just haven't seen. They had to more than double last year's total AI shipments in a single quarter.
And that velocity translates directly to their revenue forecast.
It does. Q4 revenue guided between $31 and $32 billion. The midpoint of that is a staggering 32% growth year over year.
And the ISG segment, the AI engine, is expected to grow in the mid-60s% range in Q4 alone.
Which all leads to a massive lift on the bottom line. Q4 non-GAAP EPS was guided at $3.50 plus or minus 10 cents. That's up 31%.
And the full year?
Full year FY26 EPS lifted to $9.92, plus or minus 10 cents, a 22% increase year over year. This wasn't just an incremental raise. This was a signal of a structural shift in their market position.
Let's connect this to the broader investor context. So the market reacted, clearly bullish, up almost 6% on heavy volume. But what does the demand look like behind that backlog? Is this still just a story about a handful of huge cloud companies?
Not according to management.
Correct.
They really stressed that the demand is broadening significantly. We heard about wins with hyperscalers like CoreWeave, sure, but also sovereign entities like Abu Dhabi's G42.
And specialized players like xAI.
Exactly. And they specifically mentioned major wins with the U.S. Department of Energy.
That diversification is key. It suggests the AI adoption cycle is moving into the enterprise and government phase, which is much, stickier demand.
It is. And the mix of what they're selling is improving too. The Q&A confirmed a strategic pivot in what's in the backlog. They're actively shifting towards the next-gen architecture, specifically the NVIDIA GB300.
And for the listener, why is that so important for the financial picture?
Because the GB300 allows for greater density and differentiation that justifies higher pricing and helps Dell maintain those stronger mid-single-digit margins. Even with component costs going up, it shows the margin improvement isn't just operational, it's also from selling more premium products.
And the analysts bought it. Goldman Sachs lifted its target to 185, Mizuho to 175. The consensus is clear. They believe this new $25 billion velocity is real.
Right. And then you had the appointment of David Kennedy as permanent CFO, which just reinforced stability and continuity, especially on capital returns.
Okay, that gives us the full picture. So now let's turn to our segment where we explore hypothetical trading ideas. Outrageous, but just plausible enough to discuss.
And this is the essential reminder. This is not financial advice. We're simply analyzing market dynamics and providing some hypothetical trade setups for discussion. Purely educational.
Absolutely. So the setup for this trade hinges on a clear disconnect. Before earnings, the market was focused on the short-term margin risk from that DRAM and NAND inflation.
Right. The stock had pulled back. But then management came out and explicitly said they're managing those costs better than average, while at the same time raising their AI shipment forecast by $5 billion.
So the market seems to still be too focused on, residual fears from the PC cycle?
I think so. The PC cycle and those very visible margin risks.
Huh?
The real lever here, though, is the unstoppable scale and velocity of that ISG business.
So if the idea is that the velocity is still being underestimated, what's the strategy?
The outrageous but plausible pitch is to go long via deep-in-the-money call options expiring in early 2026. The logic here is twofold.
Okay.
First, you're capitalizing on the fact that implied volatility pre-call was too high. The options market priced in a 9.3% move, but the stock only moved about 5.8%. You hedge against that overpricing. And second, you are fundamentally betting that that massive $9.4 billion Q4 shipment target is actually conservative. You're betting their cost recovery actions will work even better than modeled, leading to margin expansion sooner and continued outperformance. It's a conviction bet on execution over cyclical fear.
A very sharp thesis. Focus purely on that execution velocity. So, to summarize the critical knowledge you need to walk away with. First, record earnings driven by scale.
Second, exceptional AI momentum, confirmed by that aggressive guidance raise.
And third, strategic execution in navigating some pretty severe supply costs through their direct model.
And here's a final provocative thought for you to consider. Given that Dell secured $30 billion in AI orders in just 3 quarters, and they spent so much time talking about scarcity of parts, this raises a crucial question. Will Dell's competitive advantage in 2026 ultimately be less about technology differentiation, which commoditizes pretty quickly, and more about their supply chain's unmatched world-class ability to simply get the parts needed to fulfill that massive $18.4 billion backlog?
The supply chain as the ultimate moat. A powerful thought on what the true differentiator is in this market. Thank you for diving deep with us. We'll catch you on the next deep dive.